Hey, good morning, everybody. It's Hammer. Today is Wednesday, June 17th, 2026. I, of course, am Hammer, founder of Hammer Solutions, home of great products such as Originator Success, Grab and Go Social, and Rate Sensei. Coming to you this morning, 9:30 a.m. Eastern Time, as I do each and every weekday morning, where you can join me on Facebook and on YouTube, see what's going on that day. Coming to you from lovely New Jersey this morning, here for a wedding, which will actually be tomorrow. Today, I will be visiting my niece and working, and then tomorrow we will be at the actual wedding, and then driving home on Friday. So, anyway, as if you wanted my itinerary, you've got it now. So, good morning. So happy to have all of you. So far, I only see one person on, but I say good morning. If you are watching on the replay, do me a favor, give me a hashtag replay in the comments. Let me know that you were here. Remember, if that I'm going live, so you don't miss a moment, at HO/reminder, or use this cool QR code over here, and we'll send you a quick text as I'm going live, so you get the links and you don't miss a moment of what's going on. Also, if you just want the abridged version, you can go ahead and sign up for our daily email, the lock advice coming by email each and every weekday morning. And you can sign up for that at ratelockadvice.com. Feel free to use it any way you see fit. You can take it, you can pull from it, you can put it in ChatGPT and send a version out to your agents, whatever you want to do with it. You've got my blessing. Go to town. And then if you want to support us as well as protect your pipeline, make sure you sign up for our text alerts at ratetextalerts.com. It's a tractor. There's a tractor driving down the road over here. Oh, anyway, it'll be a moment. So ratetextalerts.com for those as well. Good morning, Rob Wilson. Good morning, Jesse Lynch, Mike Morano. So hope all is well in your world. All right, let's jump in and get started. We got a lot to cover, so we will go ahead and get to it. Let's start off with the technicals. Let me share my screen, and I'll show you what we got going on this morning. So starting off with the technical, bonds currently up 3 basis points a day, shattering, but it's building on improvement over the last over here at Japanese. What you're looking at on this side, and things are going this back securities as you improvement. This upward movement and improvements are shown in green. These upward improvements here that we've seen have helped rate sheet pricing improve over the last few days, as you could actually see over here, using Mortgage News Daily as a reference point, say for a while. And now that has worked its way down to 6.54. Again, these are just an average on rate sheets that they use. It's great for referencing for consistency more than anything else for that. So anyway, the 10-year treasury yield, also important to be keeping an eye on right now, and is also improving, 4.43. This is a little bit of a different chart. We are monitoring the yield, so that actually we want it to go down. Green goes down in this chart, and you can see that since earlier in June, when we kind of capped out over here at this high point, bonds, or the 10-year treasury yield specifically, has improved. The yield has gone down, and that's helping our rate sheet pricing. So quick recap of what happened yesterday. If we look at this chart down here, all the way in the bottom right-hand side of the screen down here, we're looking at the 48-hour chart. And as these spike higher, again, that's going to put a smile on your face, because that means better pricing. You could see that as the day went on, even though, see this, yeah, it's kind of hard to see, but see this dotted line right here? This is the break between yesterday and today. So you could see that we actually peaked around 4 o'clock-ish, 4 p.m. Eastern Standard Time here. And that they did fall down a little bit. But even still, on the day, we did see some nice improvement on the day. Again, this moved up, which is what we want to see. There were quite a few lenders that repriced better yesterday. Those that didn't reprice better yesterday, you should be seeing at least better pricing this morning for sure. So rate sheets today, as we talked about, they're going to be even slightly better. Yesterday was 6.54. To start the day, we should see at least a little bit of improvement. But again, notice that we're seeing rate sheets kind of creep lower. We saw one initial movement right here. We saw our biggest movement when it was announced that there was a deal coming with Iran, and it was a real deal, a real announcement. But since then, just little creeping, a little bit lower, a little bit lower, a little bit lower, a little bit lower. Now, that deal is supposed to be signed on Friday. There's a lot of headlines about that deal and what's included in that deal. Things like the $300 billion fund that is supposed to be made available for Iran. They wanted money, and supposedly this isn't the U.S. paying off Iran, but different countries that I guess owe the money, and things that have been pledged. But there's definitely some concerns here. It's always kind of, it wouldn't be a Trump thing. Another that I read, we didn't like it, we'd go back to bombing. Yeah, see right here, we'll go right back to dropping bombs right smack in the middle of their head. So, always inflammatory, but that's Trump, and hopefully, again, that we don't see anything that does issue. If we do see a problem with this, and again, the reason we care about this is not political commentary; it's where markets are going. But if we see something going on with Israel and Hezbollah, and if Netanyahu does not cooperate, because Trump has kind of pioneered or led this whole peace negotiation, but it's not something necessarily that Israel is going to stick to. So hopefully that doesn't become a big deal. Other things to see this morning, we just go ahead and cover real quick. Rate price risk on the day is moderate. We're going to have, of course, today is Fed Day. So we've got the Fed's dot plot. This is going to be a little bit more interesting because we're curious to see if other Fed are thinking that rates are higher this year than what's anticipated at the last dot plot. I think we are going to see that. I think you're going to see more of the different Fed members pointing to rate hikes. So we're gonna, we'll talk more about the Fed in a minute, but right now we're kind of flat a little bit. If we get a hawkish Fed meeting, I don't know that it's going to be terrible because markets are already pricing in the idea of a Fed rate hike. But anyway, we'll come back to that. We'll see what that part is going. I mean, let's see some of your comment chat. Mike Morano, good morning, Doug. Mike Morano wants to point out oil at $75, a barrel. Will that remain stable? Now, let me go ahead and share my screen and show you that real quick again, too. So remember, mortgage bonds, mortgage rates are only going to be able to improve as we're seeing improvement in oil prices. But oil prices, if they're, based on where they're at right now, already quite a bit lower than our highs. Remember, we were a high of 110-ish, right around there. This internet is not the super best. Hold on, let me just, come on, load up. There it goes. Okay, so oil, Brent crude, right? So right now it's back below $80 a barrel. We don't need a year. Let's just do year to date, right? So before everything went crazy over in Iran, we were right down here. So February, at the end of February, we were looking at oil that was about $70 to $71 for Brent crude. We are back here, all the way over at the right here. We're back here at $80, and it was creeping right below that up until the last few minutes. But we're at $80. So compared to what was the high over here, 118. So we had a high of 118. Here was a high of 118. So we hit these highs a couple of times. Up here, we are oil prices significantly lower. Lower oil means less inflation. That's a big part of what's going on. But there's a lot of things where this basically is not going to allow rates to move much lower. So this is kind of what we want to focus on. How much time am I at right now, by the way? I am at 10 minutes. Okay, so let's say took a leak. Those who talk don't know. Those who know don't talk. JD Vance was pimping his book on all the channels yesterday, dispelled some of the rumors, did not discuss much of what was really in the deal. Supposedly, though, they've released the deal. There's is it Bloomberg that showed, here, read the 14-point draft memorandum. And supposedly, again, this isn't the actual final peace deal. This is the memorandum. And it still opens the door for basically negotiations to continue for another 60 days. So you're talking another couple. So we'll see all that for sure. By the way, it is National Apple Strudel Day. Thank you, Mr. Ron Siegel. National Apple Strudel Day. So anyway, getting back on here, let me show you. Taking a look here, we've seen, rates were at their best levels February 27th. That was right over here. That was our lowest. Remember, we were below 6%. And the last few days, we've come down quite a bit, but still look at how much higher we are between that low and that high. And what I've shared with you before is I think that our new floor, the lowest that we could see rates go, is probably what we saw in April. And that's right around 6.25 to 6 3/8. Reference point that puts us about a quarter point. I think we've got to work with to see things improve. Now, part of the reason for that is the economy as a whole. So like retail sales came out this morning. And really, if I were to summarize this article, it basically comes down to people with money are spending money and people that aren't, that don't have money are spending less money, but they're still spending money. All right. Credit card data are spending extra rates face just an elevated borrowing costs, but they're still spending. There's arguments that part of what they're spending is larger than usual tax refunds. So, there's more money to spend as people get more money into their pocket. But overall, they are seeing spending, right? So spending at restaurants and bars fell just a hair, but they were a really strong increase in April. So, it's not a big difference necessarily. So anyway, that's what we see going on with this part. What we want to talk about real quick is what's going on with Warsh and the Fed. So the Fed dot plot is coming out today. And if more of Fed members think rates will be higher by the end of the year, I don't necessarily think that we'll see a strong negative reaction because markets believe this is for December of 26. If you take a look here, right, markets believe that we are going to see a 60% expectation right now of a rate hike, not a cut, a rate hike. So markets are already pricing in a rate hike of at least a quarter point and even about 15 to 20% of a half a point rate hike by the end of the year. So if I think that's the signal we're going to see from the Fed and the policy statement and the dot plot. However, Warsh is going to have his press conference, and I would think he's going to push back on that because, especially for this press conference, Trump wants rates to be lower. He picked Warsh with the idea that Warsh would be able to help drive rates lower, but the economy has really, really changed since, just in the last few months. And it's not just that oil prices went up and the conflict in Iran. There's a lot of argument that AI was going to make things more productive, which was something that would, technically ease the economy because you got less jobs being created, less money being spent. But there's arguments that it's driving inflation because of the cost of chips, the cost of, all the goods associated and all the extra money that's flooding into stocks as they continue to rise on like that tech. It's I'm going to call it a bubble, but just like the tech bubble that happened, we see this AI bubble in stocks right now. So, but there's arguments that now that oil prices are coming down and energy prices come down, some services can come down, that maybe we've got, at least an economy that doesn't need hikes. Now, that's the thing is, though, how do you get Fed, rate cuts? Well, what he's going to have to point to, and I think, and again, I'm not looking at the comments, but Ron might have already said this or he said this before, but Warsh is going to be pushing to look at newer data, updated data, different sources rather than what the Fed is known to, kind of monitor. And that data may provide more of a support for rate cuts in the future. So that's kind of the argument that they're going to have to see here, because but the job market is not weak enough to require, getting propped up. The economy is not needing to be propped up. So there's a lot of argument that there's just no room to argue that we need any kind of easing bias. So we'll see what the Fed policy statement says. The statement last time on Powell's last meeting as Fed chair, they still said that they had an easing bias, but there were a lot of dissidents against that where they didn't agree with that and they wanted to take that out. And I think you're going to see that removed this time around. So anyway, I'm going to take my screen off, look at your comments. Siegel says he's optimistic. The Warsh press conference today. The one common item for all Trump appointees is they're good at public relations. You expect Warsh to be dovish in comments. Yeah, and I do too, to promote the economy, regardless of what they really do. With the MOU, that was the whatever they call it, of understanding in Iran. I think there'll be an internal push for economic stimulus, a lower emphasis on inflation fear, and more focus on the weakness in the underlying jobs market. So, yeah, I mean, it's possible. So, anyway, wrapping things up here, cautiously float. Let's see where today goes. There's a really good chance that we could see, markets respond positively to any kind of a dovish slant that Warsh does take in his press conference. We're waiting to see that. We'll see if that becomes a part of it. And there's a really good chance. If he does, if the if the Fed policy statement and dot plot look like they are more hawkish, I don't think we have to worry too much about that. I think markets already are prepared for a hawkish. If the press that he sees a way to alleviate some of that pressure and eventually cut rates, markets will be optimistic to that. So we need a little more push to see rates move lower. There is room for rates to move lower. How much lower? I think about a quarter point. We'll see. Once we get around there, we have to really assess whether it's going to push lower than that or not. We're in a different place than we were at the end of February, and I don't think rates go back down below 6 for a while. But could be wrong. We'll see where that goes. So today is a good day for that, to see where the Fed meeting goes. If you are not signed up for our text alerts, make sure you do sign up for those. We will be sending our text alerts out in this afternoon, depending on how the market reacts, whether you want to be locking or floating. You want to keep your finger on the trigger for locking some loans that are near term, closing in the next couple of weeks, possibly risk-averse loans closing in 30 days. But overall, the current outlook is that rates should continue to improve over the next month and possibly beyond, and we don't have to worry about those loans, even to a knee-jerk reaction or comments made during Warsh's press conference. So that's it for today, my friends. Make sure you're signed up for our text alerts. We will keep you posted. Of course, tomorrow, make sure you come back and join me tomorrow at 9:30 a.m. Eastern time. We'll talk about what did happen, what were the Fed actions, what was the Fed policy statement, and what did Warsh say and do during his press conference. And we'll talk about how that affects mortgage rates and where we're at from there. Of the agreement with, I think, is signed, we do see a little bit more relief. But remember, Friday is also Juneteenth and markets are closed. So tomorrow is the last day for the markets. And I don't think I will be doing a road anyway, and it's kind of a pain in the neck. And if wrapping it up for the week tomorrow, on Thursday, probably will not have a live on Friday. Haven't totally ruled it out. We'll see if anything changes tomorrow that would make it make sense. But we're not going to see a reaction anyway. So we're going to join me tomorrow, because tomorrow's going to be an important day. We'll again dive. Hopefully the flies degree and if it would work their way down. So I'll see you guys tomorrow. Hope you all have a fantastic day, my friends. Bye-bye.